Well, the governor has given everything that the market and the economy wanted. You've got your 25 bips rate cut and a little more than just the OMO. My sense is this is the first tranche of OMO. The governor has promised they're going to buy 1 trillion of bonds, 1 lakh crore of bonds. That liquidity will come in. Plus, there is this 5 billion swap that they're going to do, FX swap, which will also push in liquidity, $5 billion worth of liquidity into the system. We don't know the dates yet. That will be separately announced. But that explains why you have seen a good 5 basis point fall in the 10-year yield. The market's clearly celebrating. The rupee has been steady today. And the governor clearly indicated that they are watching every possible external data. That's about all he came to say in terms of the rupee. You know, what's the current account deficit? What is the deficit in October? What are the FPI and FDI flows? Usually so much details are not there on the external sector in the governor's speech. He just stopped short of saying something about the rupee, but otherwise he has given an extremely dovish signal. What I am waiting to ask the market is whether they are smelling another rate cut, because there was no indication that this is the end of dovishness, nor was there any indication that there is a long rope left. After all, it is still neutral stance. With that, let me invite our guests. Do we have the biggest banker? Do we have State Bank with us? Okay, let me first invite Mr. Ashwini Tewari. We also have economists and bond dealers with us. But Mr. Tewari, good morning. What have you made? This rate cut is going to once again push back margins, or do you think that, you know, it's going to be temporary? So one question on margins and another on how much might it push up credit growth?
So Lata, as you rightly said, there will be initial pressure on margins as it has been in the past, where the loan rates have transmitted quickly, but the deposit rates, especially the fixed deposit rates, correct only on maturity. So this process had been going on and would have finished in the next couple of months, but with this additional rate cut, this will push it back a little. So there will be some initial pressure, but as you rightly said, it will be temporary, and we hope to be back on track or back on even keel by the end of March, hopefully. However, this rate cut was, as you are aware, that even our house view was that maybe the rate may not be cut, but it has been cut. So overall, it's not going to make much difference as far as credit growth is concerned. We have seen very strong credit growth on the retail side. The demand is already good, and this may push it even further. That it's like a trigger. So we don't expect too much credit growth because of this, because it's already strong for us.
Okay. Is there anything else from the policy that stands out for you?
Well, the announcements are not that significant. I mean, in terms of the RBI Ombudsman scheme, which was highlighted, we are already focused on resolving all the complaints thereon, and therefore that is a continuous endeavor. I would say that the liquidity measures which have been announced are very welcome, both the OMO and the buy-sell rupee swap, because they will provide durable liquidity. And there was some pressure in terms of the bond yields and the government security, especially the state development loans whose auctions will be coming up in the last quarter. And they were kind of pushing up the rates a little. So that will now correct, hopefully, because of all this. So in that sense, that is more significant to me, I mean, apart from the policy rate cut.
No, I was expecting you to say that, because if it continues with this kind of liquidity, then hopefully you all are going to have some mark-to-market gains on your bond book as well by the end of the quarter. Let me turn to the Economist, sir. Kaushik, what is the first impression? Rate cut as you expected? Was the liquidity measure more than expected?
So Lata, we are very happy because we expected both to be announced, both liquidity and RBI rate cut. So we got the 25 rate cut, which I think was overdue. And on liquidity, we had done a calculation that by end of March 26, RBI would need to infuse 1.5 to 2 trillion INR worth of liquidity based on the currency circulation leakage, the FX intervention. So we had a calculation in our mind. As of today, RBI has announced 1.5 trillion. If you see the 1 lakh crore OMO and 5 billion swap, that's about 1.5 trillion liquidity infusion. My guess is you'll get more by the end of March 26, another 500 billion at least. It will go up to 2 trillion. And in FY27, I expect more OMO purchases to happen to take care of reserve money growth. So this is just the start of the cycle to ensure that your 1% of NDTL liquidity is maintained for a longish period, so that transmission of this rate cut and the cumulative total 125 basis points rate cut filters into the real economy with the slowest amount of lag that is possible.
Got it. Well, the more important question, Upasna Bhardwaj of Kotak Bank is also with us. Are you smelling another cut? Because the governors seem to sound very dovish about inflation in the first half of next year as well. They have brought down the forecasts considerably. Where did they start? 4.9. Now they believe both core and headline are going to be 4 or below 4. Are you smelling that he's giving himself room for another cut?
Lata, just to mention that we have been of the opinion that there was room for 25 to 50 basis of rate cut, including today's rate cut. So I still believe that inflation is benign, and the governor has reinforced that view. And I think there he himself has left room open for some kind of action going ahead. Of course, there are a lot of factors which have to be kept in mind. But at the moment, I would agree that all factors, growth, for example, has not been tweaked significantly. If at all, H1 is slightly lower going ahead. Inflation is comfortable, and re-emphasis of the fact that H1 is likely to remain very benign on inflation. All of that is suggestive of room for further action. But we'll have to weigh it as things go, because we need to also keep into account how the external sector is playing out. At the same time, on the liquidity front, also we were expecting about 1.5 lakh crore of infusion. And I think OMO plus the swaps has again come absolutely in line with what we were expecting. So this policy is a complete, I would say, in line with what we were expecting, and their guidance, I think, most importantly, has been in sync with what we were saying. So markets should be actually now happy with this.
Okay. If you all don't mind, may I take a quick poll on whether this ultra dovish inflation forecast should be interpreted as space for more. We will of course ask him in the press conference whether he sees more space to support growth. But right now, going by this dovish inflation forecast, Mr. Tewari, would you say there's another cut? I can't hear Mr. Tewari.
Sorry, I was
Kaushik,
muted. So I'm saying
cut.
pause.
Yeah, sorry, Mr. Tewari.
I'm saying pause.
Mr. Tewari, go ahead. Pause.
Yeah, I'm saying pause.
Yeah, Lata, I agree.
Shobhit Mehrotra is...
I agree with Mr. Tewari that there would be a pause on this, that they've done enough, 125 basis points. And the inflation that you're mentioning, they've just mentioned, if I'm not mistaken, up to July, September, right? They have not talked about October, December, or January, March.
Yeah, up to September. Yeah. Up to September, they said 4%. Yeah.
Yeah, but then, Lata, October, December, CPI forecast for RBI, not given in this one, but the previous one is at 5%. So keep that in mind. RBI is forward-looking. And therefore, if you have an average of 4.5% inflation for next year, which RBI has not talked about.
I get that.
There's no question for more rate cuts.
I get that, Kaushik. RBI always says that the MPR numbers are not sacrosanct. They become sacrosanct only when they come into the statement, at least from the way they behave. So what has come into the statement is 4%. So that still perhaps gives them space. But I just want a yes or a no. So there are 2 pause and 1 possible cut. Shobhit Mehrotra, you think the governor has given himself space for a cut?
Yes, Lata, I think so. I think it would depend on global factors, dollar, rupee, and but scope for another cut is there.
All right, Mr. Tewari, while you say on margins there will be limited impact, it's a temporary phenomena. On the lending front, with this kind of a cut, and now that we've seen the end, according to you, we're going to be in a pause cycle now. How much of a fillip do you think to sensitive sectors like home loans, etc., do you expect because of this? I mean, is there demand in the market for these 25 basis point rate cuts to really move the needle?
So the credit growth, as I mentioned, it was already strong for mortgages, for SME. Corporate was a little lower, as we have seen, and that was also picking up. Now, corporate demand doesn't really move on interest rate cuts like this, but I guess the retail lending, retail loans, and also home loans there will be an added incentive for people to borrow now and kind of lock in rates, especially for the shorter term personal loans, where the rates are largely kind of fixed. So therefore, there could be some pickup in the retail loans, but the loan growth is already strong. So it may be a little bit more will be seen now. Some enthusiasm will come in.
All right, a bit more movement on the retail front. Upasna, a quick word on, we didn't really hear the governor explicitly mention rupee, although he did allude to the fact that our Forex reserves are strong, FDI inflows come in, FPI outflows, of course, he attributed to the outflows from the equity markets. What are you going to want to hear from the governor specifically on the rupee that could comfort the markets, perhaps in the press conference?
I'm not too sure whether the governor is going to really emphasize too much on the situation that has recently happened. If we see the kind of move that has happened in rupee, with RBI's intervention being very limited in this round of depreciation, it clearly does suggest somewhere that this is something which the policymakers are okay with, and they are able to counter or cushion to an extent the impending troubles that we're having with the tariff related issues. So I guess, somewhere they will probably comfort to the extent only by saying that we are going to be there watching for any financial instability. But beyond that, difficult to say whether any levels or any such kind of a pace they can comment on.
Shobhit, quickly on the rupee, one, of course, there is the rate differential, although our guests have been arguing that's not the reason for, the foreign inflows into India. It's more the growth story. But one, the rate cut has happened and these Forex swaps have been announced. Do you expect in the short term some more pressure on the rupee on the back of this?
I think on a real effective exchange rate basis, we are significantly undervalued now. So it's a matter of time before things, pivot in favor of rupee. I think market is waiting for some announcement on a trade deal to happen. So given that, the way rupee has weakened in a short span of time, to my mind, most of the weakness is behind. I think it's a matter of time, we see rupee changes course.
Okay. I just wanted to ask Mr. Tewari. Mr. Tewari, the governor made specific mention that while for new deposits, the yield the rates have fallen considerably, for outstanding term deposits, it's fallen by only 32 basis points. So it looks like you all will have space to improve margins, isn't it? It looks like the rate cuts have not been passed on for outstanding deposits. Many more are left to mature. Mr. Tewari, I think you're on mute.
I'm so sorry. So what I said was that for us, the average deposit tenor is 2 to 3 years. So therefore, this deposit, as they mature, these deposits will be repriced. And that is still playing out. And that's why you see the system level 32 basis points. For us, it's a little bit more. And this latest cut again will take pushback to that extent a little bit more. But I guess in the next 1 year, we will have this repricing back again. And therefore, this will settle down once again. Okay.
But do you have the space to push down rates on new deposits also? We hear many bankers complaining that, there are small savings, there are other avenues. So even if the Reserve Bank goes on cutting, you can't pass on the lower deposit rates to new depositors.
No, newer depositors don't want to have lower rates, and it's a stated position that I think depositors also need to be taken care of. So we don't think we are going to reduce significantly, although our asset liability committee will meet and decide. But our stated view so far has been that we don't want to reduce rates, deposit rates. We want to give some benefits to the depositors. So we'll review it now and see how that goes forward. But so far, we haven't done reduction in comparison to the lending rate reduction which has happened.
Okay. So there is a margin pressure there. You're not able to cut deposits, but you will have to pass on lending because they are EBLR loans.
EBLR loans, correct. Correct.
Yeah. Okay. Oh, yeah. Let me get some more reactions from Shobhit Mehrotra also. Shobhit, what is the trajectory for the 10-year now? You said that you still expect some there is scope for another rate cut. How do you see bond yields from now to, say, February, before the budget?
If you look at the valuation of 10-year bond, given that repo rate is now down to 5.25, long-term average spread for 10-year is typically around 100 basis points. So just on that basis, 6 quarters seems to be the fair valuation of the 10-year. Today we are at close to 6.5 or just under 6.5. So there is room for yields to come down. I think with OMOs happening, with global rate cycle continuing to ease into 2026, some of the asset allocation changes which took place during this year, distorting the supply-demand balance for GSEC. If once these events are behind us, then we will see bond yields slowly coming down. Of course, OMOs will help a lot going into even March, Jan to March quarter. If the OMOs continue, bond yields will soften, and to my mind, a 6 quarter on a 10-year is a distinct possibility.
Mr. Ashwini Tewari, just quickly to step away from the policy and some of the a whole barrage of RBI notifications last evening, including, on the capital market exposure, etc., coming out, the final guidelines. Quickly, before we let you go, any thoughts on that, sir? More or less similar to what was presented in the draft itself.
So I haven't really gone through all of them. I was traveling, but nevertheless, we were not expecting too many changes. We had given some suggestions from our side. So I have to see whether those have been incorporated. And now what we'll do is that we have been preparing for this, but now we will quickly start implementing all the policies and all the opportunities which are now provided by these circulars. And very shortly, we'll revert on exactly how do we plan to do this.
All right, we'll watch out for that one. Upasna, by the way, also to point out, while the decision on the rate cut was very unanimous, it is, on the stance, there is one MPC member, Professor Ram Singh, that dissented and wanted the stance to be changed to accommodative. Last time, remember, it was 2 MPC members. Now it's down to 1. Upasna, very quickly, perhaps too early still to talk about the next rate hike cycle after this pause. Just give us your scenario as to when you expect, if at all, that cut, how long a pause, and what's the next action there?
I think at this point, if at all there's a rate cut, it will be in February. And after that, I expect a prolonged pause. And that should be continuing through FY27. And it's only in early FY28, probably, because typically to ensure that the entire impact of monetary policy transmission has played out completely, we do need, 15 to 18 months at least. So that will have to happen through the course. So I do expect a FY27 pause, and then probably, but much will depend on how, the newer GDP numbers, the new CPI readings, and in general, how the monsoons play out. And also, there are a lot of ifs and buts, of course. But at this point, given the level of information that we have, I think FY27 is a pause period.
Okay. And Kaushik, what is your reading on that? How long a pause are we in for from here on?
So I think, Ritu, this is the last rate cut that has happened, and I don't expect any more rate cuts. And in 2026, the full year, RBI will be on a pause. And probably in 2027, starting from April, June, you'll see RBI hiking interest rates. So we have a rate hike cycle penciled in for 2027, with this policy rate from 5.25 going up to 6% by end of 2027. But that's a long story, ahead. 2026, I don't expect any action from RBI. But Ritu and Lata, I don't know both of you whether you've noticed or not something interesting. The liquidity that RBI has announced, this OMO of 1 trillion and 5 billion of FX swap, they mentioned that this is for this month. So what they're saying is they're giving 1.5 trillion in December itself. So there's a whole January to March quarter which is left. And I believe and I think RBI will give more liquidity infusion in January, March as well. So February policy, when RBI comes after the budget, I think you'll get more policy announcement on liquidity, OMO purchases, and FX swap if required. But I'll be, leaning more towards OMO purchases. and therefore the yields could be supported because RBI is giving 1.5 trillion in this month. If I'm not mistaken, reading the RBI statement, it says that the liquidity is planned for this month. So that is only for December, and January, March could be more. And just to add to Shobhit's point on the bond yields, he laid down the favorable factors. One more thing which I'll add is that if you have an announcement by a global bond index provider that they're including India in the bond index, which we think can happen potentially with some lag, you'll see people taking a favorable position on India's bond yields. And therefore, probably even though RBI is at a pause kind of a scenario, the bond yields could get supported. But remember, we are getting into the budget period, 1st February. So the bond demand supply dynamic will make a lot of difference. So over there, if RBI continues to buy bonds, even if the supply goes up, that could be supportive for the bond market. And RBI's inflation forecast and growth forecast for next year, they've not changed the full year forecast. I think they have not mentioned that. So if you take the full year forecast of 6.6% of FY27 and inflation forecast of 4.5%, I think, at 525 terminal repo rate, we are at a good place, and we don't need to do more than what RBI has done on rates. On liquidity, we can expect more action from RBI.
Okay. Well, thank you very much, Kaushik, Upasna, Mr. Tewari, who I think is left, and Shobhit Mehrotra. I would say this is a near Santa Claus policy coming from the Reserve Bank. The way in which the inflation forecasts are, it doesn't look like this is the last rate cut. There is a very good reason to believe that the governor is giving himself space. Whether he gives the cut or not, we do not know. But look at the way in which it is phrased. Specifically at each point, he says that excluding gold, the core inflation will moderate by a further 50 basis points. So the forecast for the next first quarter of next year has now come down to 3.9. They had begun at 4.9. And we get a fresh forecast for the second quarter of next year, which is 4%. And immediately following that is a statement, in fact, the underlying inflation pressures are even lower as the impact of increase in prices of precious metals is over 50 basis points, which means he says the actual inflation is 3.5. He's almost saying that. So one will have to say that he's, at least as far as the statement is concerned, giving a feeling that there is space for more cuts. So you have got the cut, you've probably got a hint for another cut, and you have got, as Kaushik pointed out, near 2 trillion rupees coming in only in this month, or I'm sorry, 1.5 trillion coming in only for this month. So it's possible that more liquidity infusion will come because the governor made it very clear that we will ensure that credit is available, liquidity is available for the economy. So both on liquidity and on rates, I think this is an extremely benign policy. Maybe the other idea of benign is that growth for next year is not very high. It is at 6.7, 6.8. And for the fourth quarter, 6.5. That also gives you room to say that, yeah, we are still below potential. We are a 7% economy. And he can make an excuse for a rate cut. This is almost everything that the market would wish for, a bond trader would wish for. It's a lot of goodies for the stock market as well in terms of the lower cost of capital for both corporates and for retail borrowers, consumer durables, real estate should all be celebrating. Yes, there is a bit of a negativity for the banks, but even they will make some money on the MTM gains they make on their bonds. So I would say this is a please-all policy coming in from the governor, the last policy for this calendar. From Ritu and myself, thank you very much for joining us in this special broadcast brought to you all the way from Mint Street. We will continue with our discussions at 12 p.m. when the governor will address the press.